Clear Channel Communications LBO, Group 3.
Clear Channel Communications is a global media and entertainment company specializing in mobile and on-demand entertainment and information services. Clear Channel incorporated in 1974 and IPO'd in 1984. It is headquartered in San Antonio, Texas, and its business segments include radio broadcasting, America's outdoor advertising, and international outdoor advertising. Clear Channel operates in the United States, Canada, and Latin America, and owns 1,005 radio stations and a leading national radio network operating in the U.S. It also owns or operates 209,000 national and approximately 687,000 international outdoor advertising displays. Now let's take a look at the LBO transaction timeline. In October 2006, Clear Channel Communications began exploring strategic options with Goldman Sachs. On November 16, 2006, Clear Channel announced plans to go private, being bought out by two private equity firms, Thomas H. Lee Partners and Bain Capital Partners, for $18.7 billion. THL and Bain won the deal over Providence Equity Partners, Blackstone Group, and Kohlberg Kravis Roberts. However, some of Clear Channel's large institutional investors, specifically Fidelity Management and Research, Highfields Capital Management, and the California Public Employees Retirement System, fought the initial offer, saying it was too low. They also wanted a portion of the company's stock to remain publicly traded. Then in October 2007, after some renegotiations, Clear Channel agreed to be bought by THL and Bain for $39.20 per share. This deal stalled though because banks involved in the transaction worried that if the market got worse, it would cost them $2.7 billion in losses. These banks included Citigroup, Morgan Stanley, Credit Suisse, Royal Bank of Scotland, Deutsche Bank, and Wachovia. Clear Channel Communications successfully sued the banks involved in the deal to ensure they financed the buyout. Finally, on July 30, 2008, the transaction finally closed with THL and Bain for $36 per share. The finalized transaction had a total value of $17.9 billion. 30% of Clear Channel remained publicly traded, while Bain and THL owned 70%. This particular LBO was unlike any other that occurred in the years prior because in this transaction, the public shareholders of Clear Channel were afforded an opportunity, if they so elected, to acquire up to 30% of the stock of the new corporation formed to effect the buyout. Also, as part of the deal, Clear Channel sold 56 television stations and their websites, plus 448 smaller market radio stations to help pay long-term debt and consolidate the company as a large market radio and billboard company.
My name is Austin McBride, and I'll be covering the private equity firms as well as banks that were involved in this transaction, as well as the sources and uses of funds. After Clear Channel hired Goldman Sachs to explore strategic options for the company in October of 2006, Bain Capital and Thomas H. Lee Partners scored the deal over competitors such as Kohlberg Kravis Roberts, Providence Equity Partners, and Blackstone Group. Bain Capital was established in 1984. The firm manages multiple pools of capital including private equity, high-yield assets, mezzanine capital, and public equity. In 2008, the firm had approximately $82 billion in assets under management and had made private equity investments and add-on acquisitions of over 300 companies. Thomas H. Lee Partners was established in 1974 and is one of the oldest and most successful private equity firms. It is also one of the top growth buyout firms and has made investments and add-on acquisitions of more than 300 companies. It focuses its high value-added strategy on growth businesses through target add-on acquisitions. Banks that participated in this transaction included Citigroup, Morgan Stanley, the Royal Bank of Scotland, Wachovia, Deutsche Bank, and Credit Suisse. Collectively, these banks agreed to provide buyout financing of $19.11 billion. These banks would collectively receive fees of $400 million. During this time in 2008, the colder credit climate and failing economy led to hesitation from banks to go through with financing at an originally agreed price of $39.20 per share. The banks feared that these circumstances could lead to $2.7 billion in losses. Litigations resulted from complaints filed by Thomas H. Lee and Bain in March of 2008, and the banks were eventually forced into financing at $36 per share in July of 2008. The Clear Channel LBO transaction consisted of sources of funds of both equity and debt. The debt versus equity was structured as follows: $15.8 billion in senior secured credit facilities, $1.33 billion in senior bonds, $980 million in a note purchase, $1 billion in receivables-based credit facility, and $2.4 billion in equity securities, at a total cost of $21.5 billion. The funds were distributed as follows: $18 billion was to pay Clear Channel shareholders and option holders, approximately $1.6 billion to refinance existing debt issues on the company's balance sheet, and $0.5 billion for transaction costs.
My name is Jason Cook, and I'm going to explain some of the rationale behind the Clear Channel Communications LBO. At this time, some of the industry and company factors included steady year-over-year growth. However, despite the growth, the competition from the internet was causing the stocks within the industry to actually shrink, and this was seen as an opportunity for LBOs to come in and hence target these undervalued stocks. There's a lot of deregulation going on in the industry, as well as companies in this industry typically had strong cash flows, which made them able to shoulder the increased debt involved in the LBO, and these companies are also known as low cost of capital requirements necessary. In summary, Clear Channel Communications was a fast-growing and diversified company representing opportunities for high potential cash flows from the growing business, and divestitures were splitting the company's division in radio and TV. My name is Jason Cook, and I'm going to highlight the acquisition premium and as well explain some of the multiples that we calculated and ratios. For this specific buyout, the premium that we calculated when the share price was at a market price of $30 per share and the purchase price being $36 per share, we calculated a 20% premium. For multiples that were pulled from Goldman Sachs at the time, with a market price of $30 per share, their enterprise to EBITDA multiple was 8.5x, and at the purchase price of $36 per share, that actually jumped to a 9.8x. The enterprise value to revenue was 2.8x for $30 per share and 3.2x for $36 per share. Looking at some of the ratios, we can see that this was a highly levered buyout with a leverage ratio of total debt over EBITDA of 21.17, and looking at the coverage ratio of EBITDA to interest expense being 0.97.
Hi, my name is Tanner Larson, and I'll be finishing the remainder of the slides. So to get into the regulatory factors behind the deal, there were two main regulatory hurdles that the company needed to overcome before the deal could be taken place. So the first was through the Federal Communications Commission, or the FCC, which set a limit on the number of broadcast stations an entity could own. Secondly was through the United States Department of Justice, and particularly through the Hart-Scott-Rodino Act, or the HSR Act, which determined whether a transaction would adversely affect U.S. commerce under antitrust laws. So for example, the Clear Channel deal was reviewed under the HSR Act to determine if its new owners, through their various investments, could drive up ad rates on radio and TV airwaves and local newspapers, specifically through their control over multiple properties. Eventually, the Clear Channel merger was approved. However, it was under the conditions that they divest certain radio stations post-merger. There were also some regulatory issues behind Bain and Thomas H. Lee Partners. They had been potential bidders for a Tribune Company, which was a close competitor to Clear Channel at the time. However, both of which backed out of the deal due to ownership ceilings and further potential regulatory issues. One of the most interesting parts about this deal was the use of a reverse merger to complete the transaction. This meant that Bain and Thomas H. Lee Partners created an entirely separate new entity with the sole purpose of acquiring Clear Channel. CC Media Holdings, the new company, would be responsible for the equity portion of the deal, and its new subsidiary MergeCo would cover the debt financing. What makes a reverse merger so interesting is that Clear Channel shareholders would be treated as incorporators or founders of CC Media Holdings. Under Section 351 Tax Code, which says, "No gain or loss shall be recognized if property is transferred to a corporation," shareholders of Clear Channel were protected from paying taxes on any gains or losses from the deal. So to close, we'd like to answer the question of where is Clear Channel now? So in 2008, CC Media Holdings initially began trading at $18 a share. However, this declined down to just $8 after getting negative views from the public. In 2010, the company continued to struggle as it was threatened with bankruptcy due to the crippling debt that it had taken on in the first place. and in order to fix things internally, Mark Mays was asked to step down as president and CEO. Going into 2014, the company desired to pivot into digital media and rebranded themselves as iHeartMedia Holdings. However, as we know, in 2018, this pivot proved to be unsuccessful as the company was forced to file bankruptcy and attempt to restructure part of that $20 billion of debt that it had originally taken in the transaction. One of the things that this teaches us about LBOs is that not all LBOs are successful, and oftentimes that huge amount of debt that a company must take on is often crippling to their future business.